It begins with a silence that shouldn't exist, a skyline of half-finished towers, cranes frozen mid-air, and empty highways stretching into the fog. For decades, China's cities had risen with unstoppable force. Every year, new roads, airports, and apartment blocks reshaped the horizon. It was the greatest construction boom in human history, a transformation so vast that it lifted 800 million people from poverty and turned a once agrarian nation into the world's manufacturing powerhouse. Yet beneath the steel and concrete, a question lingers. What if the miracle that built modern China was also building its downfall? What if the engine of growth, investment, credit, and construction had quietly become an empire of debt? To understand China's rise, we must return to 1978, when the country stood at a crossroads. Mao Zedong was dead, and the Cultural Revolution had left the economy shattered. Into this vacuum stepped a pragmatic reformer, Deng Xiaoping, who promised a new direction. It doesn't matter whether a cat is black or white, as long as it catches mice. Those words became the foundation of China's economic rebirth. Markets were cautiously reopened, farmers were allowed to sell their surplus, and foreign companies were invited to invest. The result was explosive. By the 1980s, special economic zones like Shenzhen transformed from fishing villages into industrial hubs, producing cheap goods for the world. Foreign capital poured in, wages rose, and China began to stitch itself into the fabric of globalization. But the real acceleration came in the 1990s and 2000s, when China joined the World Trade Organization in 2001. The timing was perfect. Western companies, hungry for profit, outsourced manufacturing to China, drawn by its low labor costs and disciplined workforce. Container ships loaded with electronics, clothing, and machinery flowed out of Chinese ports. Every factory that closed in Detroit, Manchester, or Milan seemed to reappear in Guangdong or Shanghai. China became the world's workshop, its economy growing at 10% a year. The Communist Party framed this not just as progress, but as destiny, the great rejuvenation of the Chinese nation. But behind the rhetoric lay a fragile balance. Exports fueled the economy, but investment fueled the exports. Factories needed roads, ports, and power plants. Workers needed housing, hospitals, and schools. To keep up, local governments borrowed heavily to fund infrastructure. Banks, controlled by the state, created credit on command. When the 2008 global financial crisis struck and Western demand collapsed, China didn't slow down, it sped up. The central government unleashed a stimulus package worth $586 billion, equivalent to nearly 13% of its GDP. It was the largest in history. Steel mills, cement plants, and construction firms roared back to life. Entire cities appeared almost overnight. Some filled, others eerily empty. The phrase "ghost city" entered the global vocabulary. For a time it seemed to work. While the West suffered recession, China's growth stayed above 9%. The model, investment-driven expansion backed by cheap credit, became gospel. But like all miracles, it carried a cost hidden in plain sight. Every bridge, airport, and high-speed rail line added GDP today, but debt tomorrow. Local governments, unable to tax land ownership directly, found a workaround. They sold land use rights to developers, who borrowed from state banks to build more. As long as property prices rose, everyone looked prosperous. But the system was circular. Growth depended on construction depended on debt, and debt depended on confidence that property values would never fall. By the 2000s, that confidence began to strain. China's total debt, public and private, tripled in a decade. reaching more than 280% of GDP by 2020. Entire industries depended on leverage. The property sector alone accounted for nearly 30% of the economy when its ripple effects were included. Developers like Evergrande became symbols of both success and excess. Founded in 1996, Evergrande grew into one of the world's largest real estate companies, building not just homes, but theme parks, hospitals, and even electric cars. It borrowed hundreds of billions of dollars to finance its expansion, a web of loans, bonds, and shadow banking products sold to ordinary Chinese citizens. For years, it seemed unstoppable. But beneath the glossy ads and model apartments, the numbers didn't add up. In 2021, the illusion cracked. As regulators tightened credit to curb speculation, developers began to run out of cash. Evergrande defaulted on its debt, over $300 billion worth, triggering panic across global markets. Construction stalled on hundreds of projects. Home buyers who had already paid deposits were left with unfinished apartments. The property market, once the cornerstone of China's growth, became its greatest liability. Yet the government hesitated to allow a full collapse, fearing social unrest. It was too big to fail, but also too big to save. This wasn't just a housing story, it was a structural reckoning. For decades, China's growth model had relied on three pillars: exports, investment, and cheap labor. But wages had risen, global demand had plateaued, and infrastructure was already overbuilt. To sustain momentum, the state turned to financial engineering, debt-funded projects, local government financing vehicles, and a vast shadow banking system that blurred the line between public and private credit. It worked until it didn't. The slowdown that followed was not a sudden crash, but a drawn-out deflation of expectations. The same quiet stagnation Japan faced after its own asset bubble burst in 1990. By the mid-2020s, China's demographic reality added another layer of pressure. The one-child policy, enforced for decades, had created an aging population and shrinking workforce. In 2023, China recorded its first population decline in 6 decades. Fewer workers meant fewer consumers, fewer taxpayers, and fewer homebuyers. Meanwhile, productivity growth slowed. The factories that once powered the miracle began to relocate to cheaper countries: Vietnam, Bangladesh, India. The empire of manufacturing was losing its edge, but the empire of debt remained. The government responded with familiar tools: stimulus, monetary easing, and political slogans about common prosperity. New industries, green energy, semiconductors, artificial intelligence, were promoted as the next chapter of growth. But the deeper issue was not technology, it was trust. The Chinese middle class, whose savings were tied up in property, had lost confidence. When people stop believing that tomorrow will be richer than today, an economy loses its engine, no matter how many roads or robots it builds. Internationally, the consequences are profound. For decades, China's demand for raw materials fueled global commodity booms. Its surplus capital built infrastructure across Africa, Asia, and Latin America through the Belt and Road Initiative. Now, as domestic growth falters, those flows are slowing. The same pattern that defined empires before, expansion through credit, followed by contraction through debt, is repeating on a planetary scale. The China boom reshaped globalization. Its slowdown may reshape it again. But this story is not about China alone. It is about the paradox at the heart of modern capitalism. The belief that growth can be engineered forever through credit. From America's housing bubble to Japan's asset collapse to China's property boom, the pattern is the same. debt creates prosperity until it demands repayment. Every skyscraper, every factory, every stimulus plan is built not just on steel and ambition, but on time borrowed from the future. Three truths remain. First, no economy can grow indefinitely on construction and credit. Eventually, foundations crack. Second, prosperity that relies on debt breeds fragility, not strength, because confidence, once lost, cannot be rebuilt with policy alone. And third, the story of China's boom is not a foreign story. It is the mirror of our own world, where nations, companies, and individuals keep building, borrowing, and believing that gravity has been suspended. If this story made you see growth differently, subscribe to Economic Collapse. Because the next great slowdown won't begin with a crash. It will begin, as all slow declines do, in silence.